Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. You see, back in August-September 2020, when I was looking for value stocks to recommend to my Microcap Millionaire subscribers, I decided to take a look at power sector stocks. Two stocks in particular caught my attention. Let us call them Stock A and Stock B for the moment. Now here's how their financials stacked up against each other. Company A had a pretty stable earnings profile going back 7 years. The earnings had moved within a narrow and there is a high degree of predictability of what earnings may look like in the future. Since power companies usually have high debt, the average debt to equity ratio of company A wasn't particularly, eyebrow raising. At 11.2%, its average return on equity over the last 5 years was also decent. Now coming to company B, it was quite evident based on historical parameters that company A was superior to company B. Earnings of company B had moved all over the place, lacking consistency as well as stability. Its average debt to equity ratio was also much higher than company A, and its average ROE was also a poor 4.5%. Now let's try and do a small valuation exercise for the two companies. The earnings power of company A is nothing but the average earnings over the last 5 to 7 years, which in this case comes to around rupees 11.3 per share. This earnings power means that the company can be expected to earn at least 11.3 per share on a consistent basis in the future, provided nothing drastically goes wrong with its fundamentals. To this rupees 11.3 per share earnings power, we give a price to earnings multiple of around 15 times, which I think is quite okay for a stable company like company A. Now, if it had a much higher return on equity and also growth in earnings, we could have given it a much higher PE multiple. But since its ROE is average and there has hardly been any growth in the past, a multiple of 15 times is good enough in my view. So an earnings power of rupees 11.3 per share and a PE multiple of 15 times gives us an intrinsic value for the stock of almost rupees 170 per share. Next comes the most important concept in investing, the concept of margin of safety. You see, we use margin of safety to protect us against a worse than expected future. There is always a long list of things that can go wrong with a company, and therefore to minimize the possibility of a loss, should any such adverse event happen, we recommend a margin of safety of 25% for company A. This means that we will not buy the company at rupees 170 per share, but at a price that's 25% lower. This maximum buy price comes to rupees 127 per share. So we will be a buyer in the stock only if the price is rupees 127 per share or lower. Anything more than that and we will reject it and wait for it to fall below its maximum buy price. Now coming to company B, although the average EPS or the earnings power of company B is rupees 6 per share, its quality is not that great. We could say with a high degree of confidence in the case of company A that its earnings will remain consistent and stable in the future. But any such confidence is missing in company B based on its past performance. We don't know for sure whether company B will report an EPS of rupees 6 per share in the future. It can be anything ranging from minus 1.1 to rupees 9 per share. What do we do in such cases? Well, we either reject the company because of its bad and unpredictable earnings quality or insist on a significantly higher margin of safety. In this case, let us go with the second option, that is, insist on a much greater margin of safety. Therefore, the margin of safety in this case has been jacked up to as much as 40%. If it's 25% in case of company A, we take it up to 40% for company B because of the lesser reliability of its earnings power. So if the intrinsic value of company B comes to around rupees 90 per share, we will be a buyer only if the stock price goes to below rupees 54 per share, that is a discount of 40%. Consequently, this now makes the maximum buy price for company A to be rupees 127 per share and for company B to be rupees 56 per share. Well, interestingly, both these companies were trading below their maximum buy price back in September 2020. While company A was trading well below its maximum buy price of rupees 127, company B was only marginally above its maximum buy price. Therefore, investors wanting to invest in power stocks could have considered any one of the two options, although the upside and the earnings quality was more in favor of Company A than Company B. Okay, here comes the interesting part. Company A is none other than the power sector behemoth NTPC, while Company B is Tata Power, India's largest integrated power company. And guess what? Investors investing in Tata Power back in September 2020 would have made way more money than investors in NTPC. While NTPC is up almost 80% since then, Tata Power has recorded close to a whopping 350% gains. How did this happen? How did a fundamentally stronger and a more undervalued stock ended up underperforming Tata Power by such a big margin? How did we not anticipate such a move? You see, when we valued both NTPC as well as Tata Power, we assumed that the future is going to be a replica of the past. In fact, we assumed it to be slightly worse than the past and therefore had that margin of safety of 25% and 40% respectively. I think herein lies the beauty of value investing and why it is such a wonderful way of making money in stocks. Your maximum buy price should be such that you are well protected in case things don't go your way. On the other hand, if things turn out to be better than the past, your upside could be huge. Take a look at what happened to NTPC and Tata Power earnings per share post September 2020. NTPC has improved upon its earnings power of Rs 11.3 per share and recorded FY21 EPS of 15.1 and trailing 12-month EPS of 16.6. We were prepared for an EPS of Rs 8.5 per share if you consider the margin of safety, and the company delivered almost twice of that. So far so good. However, things start getting tricky when it comes to Tata Power. The almost 5x growth in the company's share price has not been supported by growth in earnings. In fact, if anything, the EPS of the company in FY21 and even on a TTM basis is below its earnings power of Rs 6 per share. Now this is bizarre, isn't it? The company has not grown its earnings much and yet its stock price has recorded a whopping 350% gains. I think the main reason for this is that investors are expecting great things from the company going forward. They are expecting its earnings to record a massive boost in the foreseeable future, and they are willing to pay upfront for it. Now I guess this is all fine, but what if the earnings growth doesn't materialize, or it takes much longer than expected to do so? You see, if you consider the P multiple of even 20x for a company like Tata Power, it will have to generate an EPS of Rs 12 to 13 per share in order to justify its current share price. Can it achieve an EPS of Rs 12 to 13 per share? Its historical earnings power has been Rs 6 per share. Well, nothing is impossible. But if you ask me, I won't take that chance. It is a situation where if you invest at the current price, your upside could be quite limited if things go as per plan. However, you are exposing yourself to a huge downside risk if things take a turn for the worse. Now, truth be told, if there is a delay on the company's part and if markets continue to be in a bad mood, the stock price can go for a toss. A decline of even 40% to 50% from its top cannot be ruled out. As a matter of fact, the stock has already declined by 16% from its highs as I record this. You see, the way I approach investing, the risk reward of investing in the stock at the current price is certainly not in favor of investors. Also, since the holding period in my strategies typically range from 2 to 3 years, and I am not a believer of truly long-term investing, I may even recommend exiting the stock assuming I had recommended it a couple of years ago and I am sitting on some very strong gains. So to sum up, Tata Power is not a bad company, but its valuations seem to be running way ahead of the fundamentals at the moment, and this makes it susceptible to a big correction in its price. What do you think of this view? Does it make sense to you? Do give your feedback in the comment section and also do not forget to give it a thumbs up in case you liked the video. I will end my session here and I'll see you again next time. Goodbye and take care.